Welcome to the Small Axe Podcast. It's your boy Nico, the multifamily family man. We are going to talk about everything regarding multifamily real estate investing. Stick with me. This podcast episode is going to be epic. Buenos días, buenas tardes, buenas noches, mi familia. So it is me, Nico, and today I want to chat a little bit about underwriting. And underwriting is probably my favorite topic, and I don't really talk about it enough. And I was thinking about it this morning. What can I offer my viewers, my audience, my loved ones? Something valuable, right? And I talk a lot about theory a lot of times, and today I just want to talk about underwriting theory, not like what's going on in the market, what's going on in the economy, not showing you what's going on in my portfolio. I want to talk about underwriting because it's an extremely exciting topic for me. So let's jump into it. Okay, so underwriting is extremely important and then not that important at the same time. And what I mean by that is you have to know what you're getting into. You have to understand how the property is going to function, how the property is going to operate, and how you're going to operate the property through a business plan for years to come. But at that same point, we have to understand that you're creating a pro forma when you're underwriting, and a pro forma is a projection, and we don't know what's going to happen in the future. We can plan and try as much as we want to kind of create the future, but in reality, we never really know exactly what's going to happen. So it is extremely important and also not that important. But if you don't understand the basics, the beginning of how to underwrite or create a pro forma, you're never going to succeed, because creating a pro forma is never going to be perfect, but you got to try to get as close to perfect as possible. So when I first look at a deal, I look at a few things. First of all, is it the construction type that I like? Is it in the location that I like, right? So I try to rule things out right away because hundreds of deals can pass my inbox weekly. And I just want to weed it out to kind of narrow down my buy box to begin the filtering process, which is crucial. Is this property for me based on, first of all, construction type, location, etc., and year built and vintage and all of those factors as well. So create a buy box for yourself today. What vintage are you looking at? Maybe it can be 1970s or newer. Maybe it's 2000 and newer. Maybe you don't care if it's 1900s. And some markets only permit you to buy early 1900s properties, because that's all really the majority of the construction type anyway. Narrow it down. And then what construction type do you want? So for me personally, here's my quick buy box, and you should develop your own as well. I look at 1970s or 80s and newer properties. I look at concrete block construction, and I look at the Central Florida market, typically Lakeland and the surrounding areas of Lakeland, as long as there's growing population and absorption happening with the current inventory. I also look to acquire pitched roofs rather than flat, and I also look for properties that are not located in a flood zone. So right there, it helps me narrow down my buy box a bit. So come up with your own buy box and start weeding through the noise. Then when I find a property that fits my buy box, I will open it up. I'll look at the marketing package. In a marketing package, you're going to get a few things, typically a rent roll, a T12, and an OM offering memorandum. Now the rent roll is going to show you the units, the unit type and count, and who is living there if there are leases signed, and how much rent they're paying. Sometimes you can get unit sizes, sometimes you can get square footage and the unit mix. Not always though. And then we also have a T12, and a T12 is a trailing 12-month statement. Typically, sometimes it's a T3, sometimes it's a T6. Some people call it a P&L, right? So there's a variety of these financial statements. We're looking for a T12 to show a year or a 12-month snapshot of how the property has been operating with income and expenses. So the T12 was going to show you the income and expenses. And if there's some large gaps in income or some crazy missing expenses, you should be able to identify those there. It's a great thing to look at upfront. Before you even begin your underwriting, you should be looking at it. Maybe by looking at the T12, you can indicate up months and down months and what's going on. Maybe vacancy is going to be bigger certain months than other months. Maybe you're going to have high or inflated expenses, and it could be due to CapEx expenditures, capital expenditures, right? Or You can discover whether or not people are paying their own utilities, right? Because if there's a very low utility bill, perhaps each unit is paying its own electric or water or both or none, right? So those are some indicators. And then you're going to get a taste of what type of expenses there are. Maybe there's a lot of repairs and maintenance. Maybe there's a very low number for repairs and maintenance and you have to dive deeper. Perhaps there's no property management on there, no property management fee. Maybe they're self-managing. Maybe there's no taxes shown or insurance shown, and that could be an issue. So the T12 and the rent roll are great indicators of how a property can operate and just kind of getting a feel or a vibe for the property, but it's not the end all be all. And if you get the property under contract, you will discover a lot more because you're going to go through due diligence and request a lot more items and verify things on the T12 and the rent roll. Now, moving forward to the OM, the offering memorandum. So I typically look at this first, although some people really should be looking at it last, right? Because the OM is going to be an inflated, convoluted story of how the property performs based on a broker's opinion, right? So they're going to make it look fantastic. And properties don't always perform fantastic. And it actually, in my opinion today, no property that I underwrite really cash flows well unless you're offering around 50, 60, maybe 70% of the current asking price on that marketing package. So just be careful. But the marketing package can tell you a lot of great things, and it can be a very good way to start your underwriting only because it's quick. You can typically find the rent roll right on there or the unit mix broken out for you and done for you. You can see the average rents done for you. You can see some great pictures and ideas of what the property looks like inside and outside. You can also get a T12 typically on there, or at least they build some sort of pro forma as well, which you don't want to utilize, but you want to see how they're looking at the property. And then you obviously do your own underwriting. Now, once you peruse that OM and you're done with that, and once you look at the rent roll in the T12 and you're ready to start your underwriting, you open up your spreadsheet, whether it's mine or somebody else's. My deal analyzer is called the Multifamily Deal Blade, and you can get it on my Stan store, stan.store/buy buildings. You'll find it there. I also offer coursework to help you learn how to underwrite properly, and I can also do individual calls with you as well if you need me to do that. When you start your underwriting, you basically start with the rent roll. You're going to fill out the unit mix, the unit count, and the average rent. And you're going to create your own pro forma of what you think the rents can be, or keep them flat or decline them, right? And then you're going to fill out the income and expense tab, which is the T12. From there, you're going to choose financing and how you're going to finance the deal, which is crucial as well. And understand that financing is not guaranteed for each deal, right? So if you're getting a property that is 70% occupied, you're going to have to go with a specific type of loan. Alternatively, if you're looking at a highly stabilized asset, you're going to go with another type of loan, right? So lending is a huge component of underwriting. And I'm not going to go into depth of lending today, but typically for your first or fifth deal, you're going to be going with a community bank, a community lender. Now, that is not going to be the case if you're looking at a huge property like 100 plus unit. You're probably going to go with an agency lender unless it is not stabilized, and you might have to go with a bridge product. And that's something, again, for another discussion. But today, most of us will be going with either perhaps a DSCR option, which is a great option today, although rates are going to be a bit higher, or with a community bank if they will do the loan for you. And you're going to shop around the loan, but have some sort of indication today of what your lending is going to be like. So today, I would punch in a 25-year amortization, 35% down payment, and perhaps a rate of around 6.5 or 6.7 or so, maybe even 7%, just to be safe. And if you can then build out your pro forma from there and get the property to cash flow under those circumstances, you're doing great. Now, again, you have to be very careful because when you put in your taxes and insurance, the two biggest expense items on your P&L, those have to be adjusted for sale price. So when you buy a property, your taxes are going to get reassessed, and you have to learn the municipality, the county, the city, how they're going to reassess the taxes. If you don't know how they're going to reassess the taxes, just call. You have to speak with somebody on the phone to ask them, what are my taxes going to be next year if I purchase at this price point? Be very specific, okay? Make sure that you are calculating taxes and insurance properly. And it's really challenging to get an insurance quote today without having a property under contract. It's a bit of a headache and some actual work involved for an insurance agent. So what you want to do is at least speak with the insurance broker or insurance agent and say, hey, I am looking to buy this property. Where do you think at least the insurance is going to fall? Now, I can typically get a pretty good indicator from a few of my broker friends that I talk to frequently. But if you can't, speak with a number of them and get them as much information as they need. It is worth it to understand how much the insurance will be. Okay. Don't ever take the broker's opinion on it. Oh, you can get it for, you know, 1,000 a door, when in reality it might be 1,500 a door. So just be very careful. It's a huge difference that will highly affect your P&L statement and highly affect your cash flow. So you have to be very careful here. Now, once you dial in your taxes and insurance, make sure you build out the rest of your pro forma accurately as well. And again, you might not know rules of thumb for what expenses can be or should be. I'm going to give you 2 opportunities to fix that right now. Call local property managers. Speak to them. How much are people paying for X, Y, and Z expenses? Okay, that's one way to do it. And you really should speak with a number, at least 3 different property managers that are managing properties in the same area that you're looking to purchase to see what the expenses are going to cost you. And again, it's just an indicator. Yes, you're going to also use the current T12 that the seller is offering. Yes, you have to take it for face value. And yes, you will dive deeper if you get out the contract and verify those numbers. But you're going to take a combination of that plus the property managers and other owner operators in the area. If you could speak to them, that would be very helpful. And then finally, you can go to CoStar and get fairly accurate data on rules of thumb for expenses. Okay. Now, I think that they're actually not high enough, those numbers, because in my opinion, we spend more on all of those expense items that CoStar gives us rules of thumb for, but it's a very good starting point if you have nothing. How do you get access to CoStar? You should speak with the listing agent. Say, hey, I would like you to pull me a CoStar report for this address, the address in question that you're looking to purchase a property. They should build a full CoStar report for you where you can check out comps for rent, comps for sales, where you can look at how other things sold, where you can look at the market analytics like absorption rate, like population growth, like demographics. And you can also get the really good rules of thumb that they show for expenses in that particular market or submarket. You can get fairly good stuff there. So I always use CoStar. Even for new deals that I'm looking at, I will get a CoStar report just to see how things are playing out in the market. And of course, CoStar and other data tools are going to be a bit dated because they have to go backward looking. And it could be over the course of 6, 12 months that they're looking at their data for, or even longer. But it might not be actual to what today's market is operating as, but it's good enough. So start there. It's just one tool that you're going to use for your underwriting. Now back to our spreadsheet. So once you have completed the rent roll information, your pro forma rent on the same page, then your P&L is completed. Then you go to the financing and that's completed and you feel good about that. Then you're on your pro forma tab where you're building out a pro forma where you're only increasing rent increases 0 to 1% a year for a few years, or it doesn't increase at all. And your expenses are increasing for sure, 2 to 3% per year. And you feel good about that. And you feel good about the expenses. And you're somewhere near a 50% expense ratio. You're doing okay. Then you go to the next tab, which is going to talk about your exit strategy. And this is crucial. If you're buying a property with market cap rates at 7% today, you should be selling 5 years from now at 7.5%. So this is going to be a very big deal. If you project to sell at a 4% cap rate, you're going to make any deal look good if you're buying at a 7% market cap rate today. Okay, so be very careful. If you have a lower cap rate at sale than you do at purchase, the sale price is going to be inflated. Just be very careful. The typical rule of thumb historically has been to increase 10 basis points per year of ownership. So if you buy at a 7 cap, you should be selling 5 years from now at a 7.5 cap, more or less. And just be very careful. So at this point, your deal is not going to look great based on the current purchase price. This is just always how it goes. Now you're going to go back and adjust that purchase price. And if the numbers start looking good at 70 to 80% of asking price, speak with the broker and make an offer. And if the broker turns you down, say, all right, move on to the next one. That's it. Even if you spend 2 hours underwriting this deal, that's just the nature of the game. So don't quit, go to the next deal. Now, if the broker says, okay, submit the offer, break out your LOI and submit that offer today. If it gets accepted, excellent. Now you begin your due diligence and you start renegotiating if necessary. If it gets rejected, who cares? Move on to the next. You're going to have to look at about 100 deals before one of them gets under contract for you. All right, guys, that's it. If you have any more questions, you want to learn more about underwriting, I offer a full course called Buy Buildings, Build Empires to teach you everything you need to know about buying multifamily apartment buildings and operating them as well. I also have a full underwriting module in that course, so check that out as well. Go to my Stan store, stan.store/buy buildings, and go find everything you need there for becoming the best multifamily real estate investor that you can be. Get out there, have an amazing week, and know that I love you. Thank you so much for joining me today on the Small Axe Podcast. Your attention truly means the world to me. Please leave a rating and write a review. Also, share this episode with somebody that you think could get value from it. Remember, it only takes a small axe to build a lasting empire. So get out there and start building your own.